So we got three topics on this week's edition of Dollars and Cents. We're going to talk about how property actually passes. We're going to try and answer the question about whether you need a trust. And we'll talk a little bit about death and taxes. All super fun topics, if you will. Maybe not so, because they all involve kind of dying, which probably isn't an experience that we're all excited about, but we'll all do it. So perhaps this is a timely show, certainly crucial one for your money and your family and the loved ones that you leave behind when you pass away. So we're going to dig into all of those topics here on this week's edition of Dollars and Cents. Of course, as you know, the program, one of the longest running radio programs here in Central Florida, coming to you on a host of stations throughout the region. Also, the program over the past many years converted to a podcast as well, ranking as one of the top 25 financial planning podcasts on the World Wide Web, according to the good folks at FeedSpot. There, of course, you can check out any of the prior programs that we've done over the years and listen on in to whatever timely topic might be on your mind. And of course, as you know, this is an open platform in that if you have a topic that you'd like to hear us talk about, or maybe it's one that you don't think you've heard from us in a little while, well, then reach out to us, courtesy of our website, Nelson Financial Planning, or send us an email through our website, or you can even just give us a call at the office, 407-629-6477 is that office number, and let us know if there's something that you'd like to hear from us, and we'll certainly work it on into the programs. As I was sharing just the other day with a client, a lot of the topics that we come up with for the program are things that either came across our desks in terms of articles or conversations we had during the course of the week with folks, and then we take those and share them with the rest of our listening audience. So my name, of course, is Joel Garris. I'm a certified financial planner, certified financial fiduciary at Nelson Financial Planning, where we got a whole team of folks who also happen to be certified financial fiduciaries as well, combined with the fact that some of them are certified financial planners, some of them are CPAs, some of them are IRS enrolled agents, some of them are National Social Security advisors. That's the team approach that we use at Nelson Financial Planning, where we help you improve your life with a successful and cost-effective financial plan. So a couple of quick follow-ups, I guess, from last week's show. If you recall, last week we told you the story of the 23-year-old who had gotten, and I guess there's really not any other word for this, so I'm going to go with deceived by her bank when they encouraged her to open up this premium money market. She put her cash in and then was scratching her head as to, like, how come I'm not really making any interest? Came in, visited with us. We helped investigate for her, found the statements that, it's getting harder and harder. I don't know if when you log into your accounts where it can easily navigate around. It just seems like these days it's getting harder and harder to kind of like find that information. And in her case, we had to take a little bit of time to find kind of where the statements were. Was able to pull up the actual hard copy statements. Remember back in the day when you used to just get those in the mail, and now you at some point in the past clicked a button and now it's all electronic, so you don't even know when you're getting your statements anymore. That's why I'm a big fan of paper statements, by the way. But anyway, that's a little bit of digression there. So found the statement online, pulled it up, lo and behold, the interest that this rate was paying was 0.01%. So that was the story that we told last week. Anyway, she came back in this past week and had talked to her bank about it. And we thought we would share with you sort of the rest of the story. And the rest of the story is the bank's explanation, and it's just a rich explanation here. The bank actually had the gall to say to her, "Oh, the rate that we said that you were going to get was just a promo rate. By the time the account was open, you missed the promo rate, so we just kind of left the money stuck in there." Never bothered to tell her that little piece of information. Bottom line again, take a moment, really look at those statements, make sure you're getting an appropriate rate of interest, particularly when it comes to your emergency savings, your cash savings. Folks, this one is important because these opportunities to actually make a little bit of money on your emergency savings account are really few and far between. When I think about how long I've been doing this business for 25 years now, it's a rarity to see cash rates above or close to that 5% mark, which is sort of where they are now. Again, we don't expect them to stay there forever, so certainly important to sort of take advantage of that now while you have that opportunity. So bottom line, look at those statements. Make sure that you're understanding exactly what you're getting in terms of that rate of return on your cash account. There's the rest of the story, if you will. If I really just had a hard time believing that, and that's why we wanted to share it with you on the program because, well, I'm sorry, that was a promo rate and you missed it by a few days, so we just stuck it in there and you're not actually making any interest despite what the marquee out front at the bank says. Check the statements. That's where the real information is. Also, another follow-up from last week's conversation, we talked about the category of alternative investments. If you're regular listeners of the program, you know that is a category that we've always felt like was just sort of a little bit of a sales push by the industry to sort of make the average investor feel like guest special, right? Because the sort of the hook, if you will, on alternative investments, alternative mutual funds, alternative ETFs is, these are the kinds of things that work like hedge funds. Hedge funds, the things that, the super rich people have. Well, Joe and Jill Smith, congratulations. You can now own what the super rich have in the form of these alternative funds because they, in essence, work like hedge funds. We've never been a fan of that. We thought it was basically just a sales pitch to gather dollars. And then, if you recall, we shared with you sort of the 4 conclusions of a recent study, all of which sort of conclude the stuff that we've concluded a long time ago: poor performance, high expenses. These investments don't actually do what they're supposed to do. Plenty of reasons not to have. Well, lo and behold, this past week, an article hit my inbox that sadly confirms the fears that we have for these investments being pushed on regular folks. The article quoted a major institutional manager announcing that they had been able to funnel $500 million per month into these type of alternative assets, and they were happy to report that they expect trillions of dollars to flow into this. And so this push, this announcement comes shockingly after this major study that concludes that these are kind of crummy investments in the first place. So again, watch out, check those statements. The statements are where the information is, particularly those year-end statements. Check that, make sure that you don't have any of those types of investments, and watch out if you've been pitched or will get pitched on those, because certainly that is the industry push. Bottom line, check the statements. If you are unsure of whether you have those kind of alternative investments in your portfolio, as always, we invite you to come visit with us at Nelson Financial Planning to help you figure out if those are lurking in your account. Just give us a call at the office or visit our website, Nelson Financial Planning. It's a free conversation. probably likely to save you some money or avoid something that's not really going to work too well. With that, we'll take a break. And after these messages, we'll start our conversation to how property actually passes here on Dollars and Cents with Joel Garris of Nelson Financial Planning. So let's turn our attention to the main topics of discussion that we wanted to cover on this week's edition of Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. First up is the conversation of how property actually passes. When you own an investment, when you own a retirement account, when you own a house, how does that actually pass once you die? There's a lot of misconceptions out there on this one. And unfortunately, what that also means is that there's a lot of missed opportunities. And I guess chief among them is this notion that a lot of people believe that if I have a will, then I'm all set. Then all of that property will get transferred after I die, and no issues at all, no probate or anything like that. And while it's certainly important to have a will, you don't necessarily want to not have one. The reality is that a will does not avoid probate. Let me say that again. A will does not avoid probate. In fact, the will is the very document that is used in the probate process as to determine what goes where. Far too often, folks assume that because I've got a will, I can avoid the probate process. And I guess to really appreciate sort of how you can effectively approach these issues is you first have to understand how property actually passes. And so when we think of that, how property passes, it's actually going to be in one of sort of three main categories. It's either going to be by operation of law, category 1, category 2, operation of contract, or category 3, will. So those are the three main categories of how property passes. Let's talk a little bit about what each one of those means, because they're all a little different. Okay, so operation of law, that concept of how property is going to pass, has to deal with how the asset is titled. So based on the titling of the particular asset, that's how it's going to pass after you pass away, regardless of what any other document or will or anything like that says. So if we think of the main ways in which you can title property, maybe it's a joint ownership. Is it joint ownership with rights of survivorship? Is it a tenancy by the entirety? Is it a tenancy in common? We'll get to what all of those concepts means. But the reality is, here would be a good example of where the operation of law sort of trumps whatever other planning that you've done. So let's say you've got two kids, one son, one daughter. For whatever reason, you like the daughter better, and you say to the daughter, "I'm going to leave you the house that you were raised in because I like you better." And but the problem is that the actual title on the house, it was jointly with you and your son. Well, what happens in that particular case? Well, if you pass away, then it doesn't matter what you said to your daughter. It doesn't matter even if you maybe put that in the will, because of the titling, because of this concept of operation of law, then that house will in fact pass to your son rather than your daughter, regardless of what you may have said in any other document or what you may have said while you were living. And that's why it's so important to review the titling of the various assets that you have, right? So when we talk about this concept of operation of law, it really has to deal with titling of the account. If you title the account in your individual name only, then that assures that asset is going to go to probate, because again, the process of probate is proving who gets what after you're gone. And when it's an individually titled asset, there's no automatic ownership once you pass. easiest example to see how this plays out is when you have a joint tenancy with rights of survivorship. So in that case, it's 2 people or 3 people or 4 people, whatever, okay? And everybody is a joint owner, and everybody becomes the remaining owner as people pass away. So let's say there's 2 people, that's the easy one. One person passes away, it automatically goes to the remaining person, and it does that without having to go through probate. It does that irregardless of what your will or any other document you might have out there says is going to happen. So that's why it's so crucial to make sure that you're reviewing the titling of your various assets on a regular basis, because this concept of operation of law comes into play, and that in fact determines who gets what when it comes to a particular asset. Clearest example is if it's a joint tenancy with rights of survivorship, then automatically sort of the last man standing, or woman, is going to be the person that owns the property. There's other types of registrations that you can use, or titling options that you can use, but just know that that concept about operation of law has to deal with titling, which is why you always want to kind of check the titling. The other category of the 3 main categories of how property passes has to deal with this concept of operation of contract. And that simply means that that's an account where you're naming beneficiaries directly in the account titling or the account registration, or maybe in the case of like a life insurance or a retirement account, it's part of the standard agreement that you sign when you open up those accounts. Bottom line on this piece is make sure you take the time, just as you need to take the time to review how assets are titled in order to make sure that assets are going to effectively pass by operation of law. When it comes to the operation of contract concept, you've got to really take the time to double check who the beneficiaries are on the various accounts, because who you have named as a beneficiary will be the individual that gets that account once you pass. The stories are too numerous for a single episode of Dollars and Cents, but the easiest one to think of here is you name a ex-wife, or when you were married, you named the wife, you got divorced, you got remarried, but the but the prior wife was still on as a beneficiary on the account. Much to the chagrin of your new wife, you're going to find that the ex-wife is going to get it if you left her on as a beneficiary. Now, here in the state of Florida, there's some rules that sort of prevent that, but you get the idea. Make sure that you take the time to double check who you're naming as beneficiaries. And then if it's an account, so on like a retirement account or insurance contract or something like that, that's part of the standard sort of application process, right? If you've ever opened up a retirement account, they ask you, who do you want to be your beneficiaries? Another thing that you can do, though, is you can always add on a registration known as a transfer on death registration or a payable on death registration. Those effectively add in beneficiaries to a particular registration. And so ultimately then when you pass, then whoever those beneficiaries are, that's who automatically is going to get the balance or that particular asset. Now, when you name beneficiaries, there's 2 important concepts to remember. You can have primary versus contingent, and you can have per stirpes versus per capita. So let's take a moment and talk about those. Primary beneficiary, as the name suggests, is the first beneficiary. So something happens to you, goes to the first beneficiary. If the first beneficiary has predeceased you, then it goes to the contingent beneficiary. So that's the distinction between primary versus contingent beneficiaries. The other concept, per stirpes or per capita, is one that we find people that get a little tripped up on. Here's how it works. So per stirpes, stirpes is sort of Latin for by the branch, right? So stirpes, this concept basically means that it goes down the family tree, if you will. So that's the concept. So if you name 3 people per stirpes, and one of them predeceases you, then that person's share is going to go to their children. So that's how that concept works. Per capita is your classic last man standing. I named 3 people, and the last one standing gets it all if the other ones have predeceased. So understand those concepts when you're naming beneficiaries. With that, we're going to take a break here on Dollars and Cents with your host, Joel Garris of Nelson Financial Planning, and return back to this conversation of how property actually passes after these messages. Talking on the program this week about the ways in which property passes. Common misconception out there that, if I've got a will, then I'm all set. No, you're not, because the will is, in fact, the document that's used in the probate process to make sure that who you want to get your various assets is honored. The more effective or efficient and cost-effective way, though, to have property pass is to use some of these other concepts where either through titling under the concept of operation of law, property automatically passes to the other person or other people based on how the asset is actually titled, or in the situation of operation of contract where you've named specific beneficiaries, then you can have those beneficiaries directly own the property without having to go through a probate process. Before the break, we were talking about the distinction between primary beneficiary versus contingent. Primary beneficiary obviously takes first. If they have predeceased you, then the contingent beneficiaries would come into play. And then the other important concept when you're talking about beneficiaries is this notion about per capita versus per stirpe. So per capita deals with the group that you have named. So if you name 3 people, last man standing there sort of is the remaining beneficiary. In contrast, if it's per stirpes, which is a Latin expression that means by the branch, then it sort of follows the family tree. So if one person has predeceased you, it would go first to their offspring, their children, those kinds of things. So understand the difference of all of that. That's basically how operation of contract, operation of law work. Those are 2 of the 3 primary ways in which property passes. The third one, of course, is, operation of will. So we'll talk about that next here on Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. One of Central Florida's longest running radio programs, coming to you on a host of stations throughout the region. Also happen to be one of the top 25 financial planning podcasts as well. Make sure you subscribe to us on your favorite podcast platform of choice, or you can check out our YouTube channel as well. To find any of those channels on those platforms, just search for Nelson Financial Planning, or you can search for my name as well, Joel Garris. If you can't find us for some reason, well, then go to our website. Our website is Nelson Financial Planning. You'll see a bunch of icons, and obviously click on the one that looks most familiar to you. You'll get immediately connected over to the channel on that particular platform. Once there, make sure you're subscribed, and that way you don't have to do that whole process again. My name, of course, is Joel Garris. I'm a certified financial planner, certified financial fiduciary at Nelson Financial Planning, where we help people improve their lives with successful and cost-effective financial planning. So, operational law, operation of contract, 2 of the 3 primary ways in which property passes. The last one, operation of will. Provisions of a will obviously take impact upon one's death, and it is the will that, in fact, is subject to probate. That is the document that provides the roadmap for the probate process. So you really want to be thinking about some of these other ways in which property passes, either by operation of law or the actual titling on that property, or by operation of contract, naming beneficiaries, even using a trust. A trust is a document that uses this operation of contract principles to help make sure that the money winds up in the people's hands that you want it to. So consequently, those are kind of the 3 ways in which to really go through that process of establishing and properly making sure that your assets are going to pass to who you want to actually have them. Why is that so important? Well, if you've ever been involved in a probate process, you know it is quite time consuming and quite costly. So to the extent you can avoid that by, for example, titling an asset correctly, or making sure that you've named beneficiaries on a particular asset, or checking and confirming the titling and the beneficiaries that are on those assets, then the more cost-effective and easier it's going to be for your beneficiaries when you pass to just process some paperwork, show up with a death certificate, process some paperwork, and voila, the asset gets transferred to them without having to go through any kind of a court process. For more information on a lot of this stuff, particularly this topic of the ways in which property passes, we encourage you to check out our new book, Next Gen Dollars and Cents. Chapter 19 of that book really talks a lot about this and goes into a lot more detail than obviously what we're able to do on a single episode of our radio program. So if you don't have your copy of Next Gen Dollars and Cents, it is, of course, available on Amazon at any time. We also are pretty good, or the front office, Jamie, Carolyn, when you come into the office, they're pretty good at giving out free copies as well. So if you do decide to come in for one of our free consultations at Nelson Financial Planning, maybe to review the titling of your assets to make sure that that property is going to pass as effectively and efficiently as possible, or to make sure you don't have any of those alternative investments in there that we were talking about earlier in the program. When you come in for that free conversation, more often than not, they'll hook you up with a copy of the book, Next Gen Dollars and Cents. But Chapter 19 got a lot more context and content about this concept as well. So make sure you check that out. So that's the first question, how property passes. The second question that we wanted to tackle on this week's program is this notion of, do I need a trust or not? And remember, a trust sort of takes into account that operation of contract concept in terms of how property passes, because after all, that's kind of what a trust is. A trust is a contract. It's a contract that you make with your, for lack of a better expression, dead self, to ensure that the money and the assets that you have acquired in your lifetime are dispersed based upon the specific instructions that you include in your trust. So think of that trust as sort of a contract between you and your dead self and your beneficiaries at the end of the day. So when we think about trust, I think it's important to know the two main categories of trusts that are out there to really kind of set the stage. So there's really two main categories of trusts. And so one category would be your revocable trust, and the other would be your irrevocable trusts. And as the name suggests, one of which, revocable, you can change and amend and tinker with. The other one, irrevocable, as the name suggests, you can't change at any point in time. So understanding the difference between the two, obviously pretty crucial. What typically happens more often than not is while you are still living, generally your trust is going to be a revocable trust. Because remember, we've described trust as a contract between you and your dead self. So when you die, your dead self can no longer make decisions. So the trust then goes from being a revocable one to an irrevocable one. And when it's an irrevocable one, that means that the terms and the parameters can't be changed. And hopefully that sheds a little bit of light on the role that trusts play and why you hear this conversation about trust, because it does allow someone to set parameters on how their assets are going to be used after they pass. And because it goes from revocable to irrevocable at your death, that those parameters or those rules can't be changed. Sometimes that's a good thing. sometimes it's a bad thing, because you really do need to have an understanding of how trusts operate to make sure that there's enough flexibility in that trust document to give your beneficiaries the ability to sort of manage them as best as possible. Because once it's irrevocable and it cannot be changed. We're going to take a break. When we return, we're going to talk a little bit more about this trust conversation and ultimately go to answer the question of, should you have a trust or not? I think based on the description we just gave you, you may have a little sneaking suspicion as to the kinds of things that go into that decision, but we'll lay all of those out when we return here on Dollars and Cents with Joel Garris of Nelson Financial Planning. So we're trying to answer the question, or at least give you some things to think about when you're confronting the notion of, should I have a trust or should I not have a trust? First and foremost, if you've been listening to the program, you know that there's a variety of ways in which property can pass after you die. Operation of contract, operation of law, and then, of course, by the will. The concept of operation of law simply involves titling. Double check your titling on the assets. If you're simply going to be leaving them to a couple of kids, maybe there's an option to do sort of a joint tenancy with rights of survivorship type of registration that allows that asset to pass without having to go through the probate process. Similarly, with this concept of operation of contract, that simply involves double checking your beneficiaries. Who did you name on that retirement account that you opened up a long time ago? Who's on that life insurance policy or contract? And to that extent, have you named a beneficiary courtesy of a transfer on death registration or maybe a payable on death registration? Those are the kinds of things that you need to check, because if you've named somebody in that, it doesn't matter what your will says. It doesn't matter what your wishes are. What trumps everything is who you have named in those particular titling or operation of law or operation of contract types of concepts. So certainly a valuable exercise is to review the titling and the beneficiaries on any assets that you have. A trust is simply another version of that operation of contract concept, because after all, that's what a trust is. It's a contract between you and your dead self about what happens when you die in terms of the disbursement of your assets, your money, your investments. So the question of, do I need a trust? Should I have a trust? Really depends on kind of your personal situation. And if the concept is, I've got 3 kids and I love them all equally and they're all doing well, then okay, maybe a simple transfer on death registration or a payable on death registration would work pretty effectively, and you don't need to go through the process or expense of creating a trust. But let's say you're a more normal family, and in more normal families, there's always someone that might be sort of struggling. And the notion of a trust allows you to sort of put some parameters, put some guardrails on it as well. I remember one situation where we were serving as trustee, and the beneficiary, just in and out of jail, drug and alcohol dependency issues. I mean, just, the kinds of stuff that every parent really worries about. And so the use of a trust in that situation made perfect sense, because it just provided some guardrails on that individual's ability to access a bunch of money, because had they been able to access a bunch of money, chances are, based on kind of the prior pattern of behavior, that they probably were not going to make particularly good decisions with that. So those are the kinds of cases where, okay, trust certainly has a lot of value in terms of dispersing it. But more often than not, we see these trusts where it's just leave it to my 3 kids equally, or leave it to my 2 kids equally. And at the end of the day, you probably didn't need a trust in that particular situation, because had you gone through the process of establishing beneficiaries, adding payable on death beneficiaries or registration allocations to different accounts. Even so far in real estate, to do some kind of a ladybird type of deed, which effectively operates like a transfer on death on a piece of real estate, you probably could have avoided the costs and the expense and the logistics of having a trust. So again, those are the things to be thinking about when you're trying to kind of answer that question of whether to trust or not when it comes to actually creating that documents. But certainly a very personal decision, one we would encourage you to obviously to talk through with the advice of legal counsel. Obviously, lawyers are the ones that can draft up trusts and ultimately give you that guidance. Our purpose here today is to give you some things to think about as you're going through these kinds of issues. Bottom line, it's so important to make sure you're just checking the titling, checking the name beneficiaries, because that's where the real trouble can come in to play. Lastly, of course, it is tax season, so we can't talk about death without a conversation about taxes. So when we talk about death and taxes, there's really kind of a couple of different, or I'm actually going to go with 3 different types of taxes that could potentially come into play. So first involves gift taxes, second involves estate taxes, third involves income taxes. Yes, that's right. 3 different types of taxes that can come into play. Your gift taxes generally refer to gifts made during your lifetime. You're allowed to give $17,000. Actually, this year it's $18,000 to any one particular person, and that becomes a non-reportable gift, along with a variety of exceptions as well. If it's to college or if it's for education purposes, medical purposes, that allows you to give more than that $18,000. But if you're just straight out giving money, $18,000 a year is the limit that avoids any and all gift tax and, more importantly, gift tax reporting. Now, the other category is estate taxes, and I think some people refer to these as death taxes, but they're imposed on one's estate after they pass and are based on the total value of that estate's assets. Now, in this country, we have what is known as a unified estate and gift tax schedule. So what that means is that if you give away a bunch of money during your lifetime, then you're going to reduce your estate tax exemption. If you don't give away any money during your lifetime, then your estate tax exemption stays at the full amount. What is the estate tax exemption? Well, it's north of $13 million this year. Now, the reality is then that impacts very few estates, but over the course of the 25 years I've been doing this, that estate tax exemption wasn't always that high. When I started in the business, it was around $600,000. So when we think about what's going on in Washington these days and their need to, kind of at least generate some revenue to offset some of the spending that they're doing, then it would not surprise us that estate tax exemption drops down. And in fact, in 2026, it is set to automatically readjust down to $5.5 million. There's been plenty of proposals that have suggested that the folks in Washington would like to drop that number down to $2 million or $3 million. And then that starts to pick up much more of the population, still not a majority of the population, obviously, but more of the population. And that's why it's important to understand these 2 different types of taxes that can apply when it comes to money and inheriting money. The last one, income tax, is particularly important if, in fact, it is a retirement account that someone is inheriting. The reality is that if that money's never been taxed, then that person is going to have to pay taxes on it as they take that money out. So oftentimes, when you inherit money, there's no tax implications unless it involves dollars that have never been taxed along the way. If that's the case, there's mechanisms that require you to take money out within a certain period of time. And these days, the new rules involve a 10-year period whereby you're forced to take that money out. and ultimately then pay taxes on that money as it is coming out. So just understand, taxes are a part of living, and they're also a part of dying. And you need to understand the difference between those different concepts as you think about how to best plan your estate. Well, that's about it for this week. We're going to wrap it on up and get on out of here. This has been another episode of Dollars and Cents, helping you make sense of all of the different decisions involving your dollars. This year, our firm, Nelson Financial Planning, celebrates our 40th anniversary. So certainly hitting that milestone. If you, at any point in time, would like to visit with us, our consultations are always free, and we do not have account minimums. We actually believe in helping people no matter the size of their wallet. So give us a call at 407-629-6477 or visit our website, nelsonfinancialplanning.com. We look forward to seeing how we can help you have a better financial future. Thanks for listening to this week's program.